AI has been all over the news in the world, and the reality is money is pouring into the AI industry. Now, there's a very good chance that we're building an AI bubble. We don't know if and when it's going to burst, but there's a very good chance that there's an AI bubble bursting. That being said, AI is not going away. AI is going to change our economy, AI is going to change our technology, and AI is going to change our job market, period. That can create an investment opportunity. Now, for some of you, you're going to want to go out and find companies to invest in that are benefiting from this investment into AI. For others of you, maybe you don't want to do that. Maybe you just want to find a fund that can give you exposure to AI. Again, it's risky because there's a chance, well, the technology can completely shift. But if that's something that you believe in, well, now you can start looking at different ways to invest into AI, assuming that you understand that it's volatile, meaning it's going to go up and down. And if the AI bubble bursts, you can expect these funds to get hit extremely hard. How do I know? When the dot-com bubble burst, we saw dot-com companies fall by over 75%. The NASDAQ fell by 78% when the dot-com bubble burst. So you have to understand the risks, but let's talk about different ways to get exposure to AI. Option one is an ETF called BOTZ BOTS. This is an ETF, meaning fund created by a company called Global X that gives you exposure to robotics and artificial intelligence companies. Now, this fund is relatively new. It was created back around 2016, and it has averaged around 9.8% a year over the last almost 10 years since it was created. Example number two is an ETF called CHAT. C-H-A-T. This ETF is created by Roundhill Investments, and it gives you exposure to generative AI and technology companies. This ETF is even newer. It started back in 2023, and it has averaged about 25% in growth a year. But again, it's so new, which is why it's more risky, and also started during a time where AI has been exploding. I mean, over the last few years, you've seen a lot of money pour into AI, so you have to understand the risks associated with that. But maybe you say, this technology stuff is a little bit too volatile. I want to invest in something more proven, like healthcare. Well, if you believe that more money is going to flow into healthcare, you can look into certain healthcare ETFs, and let me give you a couple examples. Example number one is XLV. This is an ETF created by a company called State Street, and is giving you broad exposure to the healthcare industry. Over the last decade, this ETF has averaged about 8.7% of growth a year. Another example would be VHT. This is created by a company called Vanguard, and this is also giving you exposure to the healthcare index, and over the last decade, this has grown by around 8.4% a year. Again, to be clear, when I say average, this doesn't mean that the fund has grown by 8.4% every single year. It means it has averaged that despite the market crashes, despite the recessions. This is what the average has been. And of course, just so we're clear, past returns do not guarantee any sort of future returns. And then we have defense. And as crazy as this is going to sound, the reality is when there is more talks about war, when there is more concerns about war, there is more investment into war-related companies, defense companies. And that could create also an investment opportunity because the companies that are producing armor, tanks, jets, ammo, these are private companies. And so if those companies are getting bigger contracts from governments, not just in the United States, but from around the world, well, that can create bigger profit opportunity and potential investment opportunity if that's something that you are interested in. Let me give you a couple examples. Example number one is an ETF called ITA. This is created by a company called iShares, who is owned by BlackRock, and this is giving exposure to United States aerospace and defense companies. And over the last 10 years, this ETF has averaged around 14.5% a year. Example number two would be an ETF called PPA. This is created by a fund called Invesco. Again, this is giving exposure to aerospace and defense companies. And over the last decade, this fund has grown by around 16.9% a year. So why am I telling you these numbers? Because if you remember just a minute ago, I showed you the different types of wealth that you could have after 30 years, depending on how fast you can grow your money. And I just want you to understand the different types of returns we have seen in the past from different types of industries. Now let's talk about number two, income. And this is where I also want to remind you that for those of you that are investors or want to become investors, I did put together a brand new free investing masterclass where I'll walk you through how you can find hidden investment opportunities before everybody else. And I'll show you the exact system that my firm and I use to research investments to find opportunities before they hit the headlines like CNBC and Reddit. It's a completely free masterclass. So if you want to learn more about how you can be a better investor and research investments, there's a ton of value in there. And all you have to do is register. When you register for the masterclass, you're also going to get access to market briefs, which is my newsletter for investors, for free, all complimentary. So if you want to get the investing masterclass and market briefs, all you have to do is register, and I have that link for you down in the description below. Now, when I talk about investing for income, I mean actually producing an income, because if you buy a stock for $100 and it goes up to $200, you don't actually make any money until you sell. And then when you sell, well, now you have to pay taxes and you no longer own that asset. When you invest for income, now you buy a stock for $100, maybe it goes up to $200, but it's paying you regular income called dividends along the way, generally every 3 months, meaning every quarter. And so when we talk about investing for income, that's what we're talking about. We're talking about producing regular income, regular dividends from the investments that you're making. And the reason why some of these companies pay these dividends is because certain companies, like McDonald's, have billions of dollars of profit at the end of the year. And there's 3 things they can do with that profit. They can save that money for an emergency, they can take that money and invest it back into the company and open new stores and create better burgers, or number 3 is they can just give that money away to their investors, people like you and me, in the form of these dividends. So when we talk about income investing, we're talking about investing for those dividends, but you have to be smart, so let me go over a few examples. Example number 1 is VYM. This is an ETF created by Vanguard that's giving exposure to high dividend paying companies in the United States. And at the time of recording this video, VYM is paying out around a 2.5% annual dividend. So if you invest $100, you're going to get $2.50 in income a year just from dividends. Example number 2 is SCHD. As a disclaimer, I'm personally invested in SCHD and VYM. And SCHD, at the time of recording this video, is paying around 3.6% a year in dividends. Now you might say, well, that must be better than this one. Hold your thought. I want to show you how you can calculate this a little bit better. By the way, SCHD is created by a company called Schwab, and this is also giving exposure to United States companies that are paying out these high dividends. And then we have example number 3, MORT, M-O-R-T, which is currently paying out around 12% a year in dividends. Yes, 12% a year. Now, what does MORT do? This is called a REIT, a real estate investment trust. So this is a fund that's giving you exposure to companies that are involved in the business of mortgages and buying and selling mortgages. So more risky, which is why you're getting these higher potential returns. And now you might say, okay, Jaspreet, if my goal is to be an income investor, obviously this is the best case because I'm getting the most income, right? Wrong. When you are investing your money, you need to understand the underlying asset, the underlying investments that you're investing in. A lot of people, the mistake that they make is they get caught up on these numbers and they don't actually understand what it is that they're investing in, and it can end up costing them a lot of money. So not only do you want to look at what is the dividend today, you want to look at, well, is the dividend going to continue to grow, and what's going to happen to the value of the underlying asset? So let's take a look at what has happened with these 3 funds, and I'll give you some calculations that you can do that we can get a better understanding of what your income projections could look like. Let's start at the top. VYM over the last decade has grown, this fund has grown by around 11% a year. That's the actual ETF price, the stock price, and the dividend has grown by around 5.9% a year every single year over the last 10 years. So you're seeing dividend growth and appreciation in stock price over the last decade. The SCHD ETF has grown by around 12% a year. Again, that's the stock price. The ETF price has grown by around 12% a year for the last decade, and their dividends have grown by around 10% a year every year for the last 10 years. MORT, the mortgage REIT, has grown by around 3% a year over the last decade, while their dividends have fallen by around 3.5% a year every year for the last decade. This is why your investment analysis has to go way beyond just how much the dividend is. You want to understand the underlying asset, because if your asset is growing while the dividends are also growing, that gives you the opportunity to really compound your wealth, because every time you invest more money, not only are you making more income because you're buying more shares, but because your fund is also producing more income for every share that you own. So for example, you're investing $1,000 a month. You do this for 30 years, and you invest your money into an income fund that's paying you a 3% annual dividend. Now, what we've seen is that the 3% annual dividend is expected to grow by 5% a year, so 5% growth in the dividend that you're getting, and this fund is growing by 10% a year. What is your wealth going to grow like? Well, now what's going to happen is if you're reinvesting those dividends, you're going to end up with around $3 million at the end, plus about $30,000 a year in income, not to mention the hundreds of thousands of dollars that you've already gotten from dividends. If, on the other hand, you invest the same $1,000 a month for 30 years into a fund that's paying you 10% a year in dividends, but these dividends are falling by 3% a year, and this fund only grew by 3% a year, well, now instead of having $3 million, you're going to have $700,000 at the end of those 3 decades. And now you're going to be making about $9,000 a year in dividends. So yes, you're getting more dividends today, but if you don't look at the underlying value of the assets, you're really reducing the value of your total investments, and you're also going to reduce how much money you're going to make in income. That's why it's so important to understand what it is that you're investing in. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.